Oh, we're going to talk about products. Everybody loves to talk about products. Show me your product. What's the best product you got? I want to compare your products to these other products I've seen. And that's what clients do is just like they polled opinions in the other video we talked about where it's like, is this thing for real? And they just start asking a bunch of random people, is this for real? And then they decide if they want to move forward. Once they decide they want to move forward, they start polling a bunch of agents like, show me your product. I want to see the best product and I'm going to get all these products. I don't really know what I'm looking at. I don't really totally understand it, but if I see enough of them, I'll get to pick what the best one is. And I wish it were that simple. It's not, and that's what we're going to talk about in this video is how qualitative factors and how to analyze the quantitative factors of exactly what you're looking at, because whole life is a black box. They talk about it if you've ever researched, whereas IUL is very transparent. Here's the charges, here's the prospective credits. With whole life, it's a bundled product and you can't kind of unbundle it. So the only way to really compare apples to apples is to use the exact same inflows and outflows, whether that's premiums going in, loans or dividends going out, and you just match the exact same numbers, and then you can kind of start to see how these products stack up. And it's not totally linear. What I mean by that is certain products and carriers will be ahead maybe early, but then they'll lag late. Some of them will lag in the middle. It's kind of a weird thing going back to this structured bundled product. But this is what we do for clients is we help stress test this, not only with current dividends, but with reduced dividends, to show them under a lot of different circumstances how the different products behave. And that brings me to another point, dividends. So dividends is probably one of the biggest myths out there. And I think it comes from the fact that, we don't understand this world, or when we don't understand something, we're just trying to boil it down to the least common denominator, just something we understand, like this is better than that. So like, what's your dividend rate? What's this company's dividend rate? What's that company's dividend rate? Like if you just tell me, okay, this one's 6, this one's 5.75, well, I think I want the 6. That's better. Well, what if I told you that, like on our most recent policy comparison, we actually have it in the description. It's in the materials section of this page. This video is going to be evergreen, but 2022, we're comparing all the best policies. Guess what? The company that's paying a 6% dividend is losing to a company that's paying the 5.75% dividend. Well, what the heck? How am I supposed to make sense of that? Here's the deal. Because it's a black box, companies, the way they calculate their dividend and the way they attribute it to policies is going to be different from one company to another. So it's just a factor. So when you hear 6 and 5.75, it's really irrelevant information other than you can compare company A to company A in the past. Like they have a 6% dividend now. Well, they had 6.3 before and 6.7 before that. And what you can kind of get a relative comparison to what they've done in terms of dropping and rising dividends. But in no way does it apply to company B. Like it could be timing in terms of how that dividend is paid. It could be, dividends are paid to policyholders based on seniority, like how long they've had money in the seasoning in the policy, the amount of guaranteed cash value, the amount of permanent death benefit, whether that be base policy or paid up additions. They're all going to calculate it in different ways. So you can't compare it. And that reminds me, we do stress tests, and that is something you should look at because it's not just like what about now, is what happens if things get a little bit worse. What we can't show you is we can't show you what happens when things get better. But there was one company that actually did a really cool study where they actually pulled some policies from 1980. So over 40 years ago, where they, 50 now, 50, yeah. But pulls policy from 1980, and they showed that the policy started with this dividend rate, and then it spiked up, right, in the early to mid 80s. And then it went kind of back to where it started, and then it went down lower to what the original illustrated rate was for more than half of the total study period. I think in this case, it was a 40-year study period. Regardless, even though the dividend rate on the back end was less than what was originally showed, those dividends were like 3x, sometimes more than 3x what was originally illustrated because of that temporary spike. And it was a very short-lived spike. So it's a cool way to see. Again, we can't, because of regulations, show you what happens if dividends go up, but you can at least extrapolate through this policy of the past what is possible, especially if you think we're in a low dividend rate environment now. But I digress. Life insurance agents are kind of like restaurateurs. We all are to a degree, in that we all have access to the same ingredients. And the ingredients would be like the products from different companies. And the way that some restaurateurs operate is they have all their ingredients delivered by Cisco. Nothing wrong with Cisco, not the computer Cisco, by the way, but what they call the other Cisco, SYSCO, the white trucks with the blue writing. Massive restaurant supply company in terms of ingredients. You just get all that stuff delivered by Cisco. Makes your job as a restaurateur a lot easier. The problem is, as an insurance agent, is you kind of have one hammer and all your clients start to look like a nail, and you build some crazy narrative explaining why this is the absolute best thing all the time under every circumstance, and it's just simply not true. And that's why we did a comparison of the top 4 mutual companies when it comes to designing a policy, mainly for cash value and infinite banking. And that way you can kind of see the trade-offs and the pros and cons. But the way we run our business as restaurateurs is we like to source our ingredients from the best sources, if you will. Like we'll get our grass-fed beef from this company over here, and we'll get our fresh seafood from this company over here, and we'll get our organic vegetables over here, and our Idaho potatoes over here, and our spices over here. And it does make for a more complicated business model, but what it results to be for our clients is often a better meal. Now, ingredients alone aren't it. For instance, I could get you the best product from the best company off the shelf, but it has to do with design, or in this case, our recipes and how we cook things. And that translates to certain types, not only certain types of riders like term riders and PUA riders, and whether or not to use a 10 pay or a life paid up at 100 or a high early cash value design chassis. Like all of these things matter, but it's how we put it all together and why. And that's going to vary by age to age. And that's why in the comparison, we did a 44-year-old and a 53-year-old and a 37-year-old, and your numbers are going to be different unless you're exactly one of those ages at exactly that health rating. But that'll at least give you an idea of the variation that's possible as a restaurateur. So going back to these other factors like the recipe and how we combine things. If you haven't seen it, I made a video called Whole Life's Growth Components and its Riders. It's a really cool video. It starts out conceptually with this race car analogy, where I talk about all the different components of a race car, comparing that to the components of whole life. And then we actually do a comparison between just the off-the-shelf stock product and then different types of term blends and different types of ways that you fund it, right? Different types of ways that you as the policy owner can fund it, because certain times you need flexibility. And it's very, very telling, and you'll start to really get a good sense then of what you're looking at when you're seeing these illustrations. So I strongly suggest you check that out. Let's talk about some of those qualitative factors. So probably one of the biggest ones that we come across early is that early cash. Everybody loves early cash. It just sounds so good. I want high early cash. What's the early cash like, right? The high early cash value. I want the high early cash. But the more I talk to clients, a very small percentage of my clients actually really need this high early cash. Like I have some real estate investors and nosebleed entrepreneurs where they just need like access to everything right away all the time, and they just want this policy compounding for them. That's great, we can do that. And in that case, a high early cash chassis will probably be the best thing. Now, I realize some of you are saying, well, if I can get high early cash, why would I do anything else? Well, if I told you that it came at the expense of long-term performance, would that change your mind? Oftentimes it does, and we model that for clients. And I love this saying. I say it all the time to clients. There's no deals in insurance. Everything is priced perfectly. These actuaries that design these things, and granted, they have data for 170 plus years now, they're not giving anything away. So if you're going to get artificially enhanced or increased value early on, you kind of have to pay for it somewhere. And so that's going to usually come at the expense of back-end performance. But again, going back to the majority of my clients, the responsible savers, they either have good cash flow or they have a stockpile of savings anyway, or both. Well, usually when they can do this strategy, they want to max things out the first year, and often are going to be prepared to do so for many years in a row, even under the most adverse situations. Like, what if I lose my job? What if whatever values go down? What if I need to do improvements to my rental property or whatever? They're still going to be able to do it even if they have to borrow against the cash value. But when I ask clients, like if they have this reserve fund over here, like, okay, and that's different for everybody. Like some people have like a $10,000 reserve fund. Some people it's 50 or 100, or I've met clients where it's like they want to have $1 million in cash, right? $500,000. Like I call it the financial teddy bear. Whatever that number is, I'll say like, let's just say you're the $100,000 emergency fund guy. When's the last time you bled that 100 down to like where there's only $5,000 left in there? Right? Because you can borrow against 95% of your whole life cash value. When's the last time there was only $5,000 in there? Well, I can't remember. When's the last time there was less than 50? Can't remember. When's the last time it was less than 75? Like once, 3 years ago? Not very often. So if that's the case, do you really need to give up long-term performance for high early cash? If you do, we'll help you do it. But if you don't, why would you do that? So that's one of the kind of immediate qualitative factors that may show up as sexy for a client, but they don't realize there's a cost attributed to that due to how the sausage is made, going back to the restaurateur analogy. Another one is flexibility or catch-up. Now, the way that these products are designed, when max funded with term riders for infinite banking, there's always a certain amount of flexibility, and it can depend. So probably on like the most extreme scenario, you may only need to pay, call it 15% of your maximum premium. You may only need to pay 15% at the very low end of like, disaster struck and just like, oh my gosh, calamity, and you didn't want to cancel the policy, but you also didn't want to get out of compliance with it. So, and then maybe on the high end, it might be more like 40, like certain policies that are structured with higher minimum payments, like some of these very robust 10-pay policies, the minimum might be as much as 40%. And to some people, it doesn't bother them. To some people, it will. And there's lots of stuff in between. So these are all things that you won't necessarily see in an illustration, but we can give you context, and that may help you choose between, sourcing ingredients from this provider versus this provider. Once you know all of those things, so that's another one. And like I said, some of my clients have very steady cash flow. Most of them have pretty steady cash flow, but they just want to know that they have the flexibility, which is why they like the early cash stuff too, right? It's just another version of this financial teddy bear. And so it's worth noting that I walk through with my clients, like, let's just say this horrible thing happened, right? First of all, if you have a certain stockpile, usually you have your first year, 2, 3 years kind of just sitting there in the bank. And it's like, well, but what if I need it? Well, if you need it, it's better off putting in the policy and borrowing against it, right? So it's still there, at least, right? You have access to 95% of your cash value. And they just forget that because clients come into this with the mentality is like kind of putting money in insurance is like putting down a black hole, and I want you to stop that. There's a concept we call hybrid banking. In fact, I made a whole entire course about it. If you've done all 3 videos, if you skipped ahead to this one, I strongly suggest you go back and watch the others just so you fully get the concept. But if you've gone this far, you'll probably really enjoy my advanced hybrid banking course. It's a little bit longer, but it's quite good, and it really gets into the nitty-gritty of that, the whole borrowing thing and breaking through the mentality. And we have some really cool calculators that show some long-term arbitrage numbers and what it means when you're funneling your expenses, funneling your major purchases through a policy, even if you're borrowing against it, even if you had to you had the equity in the policy and you couldn't pay premiums, even if you had to borrow against the equity of the policy itself to pay the next premiums, that sounds scary to you. But we actually go through the mechanics and the math of doing that. And just real quick conceptually, that just sounds scary. It's like, okay, I have my equity in the policy. If I borrow against it to pay premium, again, in their mind, it's gone. But wait, let's think about this. So you have a liability over here, right? You have your policy equity, and you have a liability over here. And if you say, fill up the liability to pay the premium over here, in your mind, the equity's gone. There's not much equity there. But you just increase the policy value. So it's very, very easy to get an increase on your line of credit. And now you have that capacity, not all of it, but most of it right there. And if for whatever reason, these outside lenders, which is optimal, by the way, that's another thing that we ought to bring up. Sometimes clients get hung up on different loan options with the carriers. And they're a little bit different, but they're not that different. But it's kind of irrelevant, because if you're using one of the big major carriers, you should not do a policy loan. Here's why. There's no advantage to it. If you can get a better rate from an outside lender, and it doesn't show up on your credit, and you don't have to pay interest if you don't want to, meaning you should pay interest, but it'll just accrue on itself as long as you never violate that 95%. Why would you ever use insurance policy loan? It's less convenient. You have to call an agent, you have to call an 800 number, you have to fill out a form, versus with these outside lenders, it's a click of a button. Once you link your checking account, it's 24 hours, whether you're in or out. Right? You are borrowing money, boom, 24-hour ACH, free wire for big amounts to outside vendors. It doesn't even need to go to your checking account. You can just wire it right to where you want it to go for free. And then when you want to pay back loans, it's really, really simple, right? You just go from your checking account to the line of credit and it's done. It's simple. With policy loans, it's a little bit more cumbersome. And eventually, a lot of my clients, they start this on themselves, but they end up doing stuff on their family members, their spouses, their kids. They realize if they can get access at 95% loan to value as they're building equity, it's not an either or conversation. So that's why I want you to watch the hybrid banking course, because that will be made more clear and you'll start to get it. And anytime you're ready, you can do that concurrently. Anytime you're ready to really look at your own numbers, definitely use the button below or the link in the description. Schedule with our team. It's bankingtruth.com/schedule if you just want to type it in. It's no obligation, complimentary consultation. We're not salesy. We don't need to be. We got enough volume coming in. We're educational. Come in, talk to us. We'll answer your questions. We'll actually understand enough about your situation where we can model something out that's true to life. May not be the end-all be-all policy, but at least you got to start somewhere with some numbers so you can kind of wrap your head around it. Usually that's where the rubber meets the road, where clients kind of see numbers and go, okay, I think I want to do this, or maybe I don't, right? And if you're just not ready, like, I don't know, I don't want to talk to a human, you guys seem pretty cool, but I'm just not there yet. Fine, watch our 2022 or whatever the latest comparison video is. Right now it's the 2022 comparison. You see 44-year-old, 53, 40, 37-year-old. You'll be close enough to where you understand kind of how the metrics of optimal design policies work. Let's address one more thing. This won't apply to everybody. This is like whether to do whole life versus IUL. And some of you are like, stop right there. Wait a second. I read the old scriptures and they said the only thing you can do is whole life. Oh, gosh darn it. This is sacrilege. Yeah, I'm aware of all that. And I used to drink the same Kool-Aid and think the same thing, but I also like to test and measure the validity of things, and I took that for face value. And in about 2011, 2012, when IUL was really all the rage, it has fallen from grace a little bit since then, but it was really, really a hot and sexy product at the time. I remember just constantly coming into competition against it with clients, and so I started really doing some digging on my own and realized that Yes, kind of like if you get the stock off the shelf versions, it probably wasn't a good thing, and there's a good chance that the fees could go against you and it could blow up on you and all these horrible things that people say. But that if a policy is designed properly, where you're paying the maximum premium you can pay and the least death benefit you can pay, IUL is already kind of naturally designed like a term rider. Like that's basically what it is underneath. In fact, the whole life term riders look kind of just like IUL. The only reason those aren't so scary is they're just kind of temporary things, versus IUL is perpetually like that. But again, if you fund it properly, you take a lot of those risks out of play, and there is the potential for greater performance, although there's no guarantee. So a lot of my clients are just confused, like, should I do this? Should I do that? I'm a big and guy. So, and I'm not saying like, I'm not trying to double sell you like, yeah, I'm going to sell them too big policy. Yeah. I'm just saying whatever total spend amount you were going to do, you could break it up between the two. Or what I actually prefer, and what I did myself, and what I'm glad I did, and what a lot of my clients seem to gravitate towards, is setting up the foundation with whole life, and then going back for layers of IUL. And here's why. Again, the 95% loan to value is unique to whole life. To get that high of a loan to value ought to show you something in terms of its risk profile. If a bank will freaking offer you that, a bank doesn't take any risk at all. There's a great saying, bank will loan you money if you can prove you don't need it. It's Bob Hope who said that. And so if they're willing to loan you 95% cash loan to value, then they feel pretty good that is not going to go backwards on them. And that's exactly why I like it as my foundation, because the guaranteed cash value, even if there's no dividend paid, is guaranteed to go up every single year. So even if I'm max loan, which actually at the moment I am right now, because I've been using money for other things, and actually using some of it to pay some of the IUL premiums, when that happens, I don't need to worry about 0% years or fees going up or whatever. Like, that loan won't really get away from me. So I like that. And with IUL, if you fund and structure the policy properly, yes, the carrier does reserve the right to raise the internal charges. Most of them haven't or won't because they don't want egg on their face. And usually that comes with class action lawsuits because they have to justify why they're raising the charges. Like, if people are living longer, how are you raising the charges? But they do reserve the right to do that if there's something like bird flu. And so regardless, that is to me a minimal risk. And if you fund a policy properly to where if all your cash value is there, everything you've paid into it is there. Sometimes between year 3 and year 7, I don't really consider myself at risk, since I can just pull all my money out if like the whole thing goes south. But I don't want that to be my foundation. The other thing that is a big concern with IUL is people say, well, as I get older, I've heard that the fees definitely go up. And it's yes and no. It's true in that the cost per unit of insurance does go up every single year. But if you fund it properly, the cash value is converging upon the death benefit to where the units of insurance that you're paying here are less than what you pay here. And so the cost of insurance may in fact go down and may stay steady. And these are the things that we model out for clients on the IUL side. So not saying you should pick one or the other. I have a preference that I like the certainty. I like the extra liquidity as my base layer. And then I may layer on some additional performance models on top. And what's cool is, going back to the extra bites of the apple, you don't get quite as much loan to value on the IUL side. If you're using one of these outside lenders, it may only be 80, 85, 90% loan to value. As opposed to the 95 on whole life. And if you borrow against the policy itself, a lot of times you can get into the low 90s, but they won't have a rate as good as the banks. There are a couple carriers that are the exception. Their rates, you can get 90-some% loan to value, and their rates are just as good as the banks. You can't lump it into that convenient line of credit. But what's nice is from an equity standpoint, even if you borrowed against your whole life to fund an IUL or even a thin layer of IUL on top, okay, you remove some equity over here, but at least you pick it up over here. So I don't think it's an either or conversation. If you're just getting started out, it is something to consider as an enhancement or a performance enhancer, possibly. It's just the potential. There's no guarantee. There are extra risks, but if it's designed properly, it can be mitigated. Again, my suggestion is that you use the schedule button to book a complimentary consultation with our team, and we can model this out for you, and you can start to take some of this conceptual knowledge, which hopefully was helpful for everybody, and start to apply some numbers to it and see if this is right for you, and if so, to what degree, like how much. And we also have some pretty good planning ideas in terms of how to maximize your cash flow. A lot of times clients have one foot on the gas, one foot on the brakes, like I'm max funding my mortgage and like I'm overpaying my mortgage and I'm max funding my 401k. Well, wait a second. You're overfunding you're max funding your 401k because you want a big deduction, but then you're max funding a cheap ass 15-year mortgage and you're getting rid of a deduction. Like, dude, and you're worried about liquidity. Like, that's not liquid and that's not very liquid. Like, what's going on here? This is crazy town. So a lot of times we can turn the dials, or at least give you some suggestions to kind of get all your different what we call junk drawer financial plans, right? You kind of do a little college planning here, a little 401k here, a little mortgage here, and you're just kind of doing all this random things, not realizing that you got one foot on the gas, one foot on the brakes. So we might have some suggestions there. Might create a little financial efficiency in determining how to fund this whole private family bank thing. So hopefully this was cool. Hopefully this was helpful. Again, if you haven't checked out the hybrid banking course, definitely check it out. Book a meeting below, and we will talk to you soon.